Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. I'm your host, Daryl Thomas, and today you are in for a treat. You are receiving exclusive content from the New Orleans Investment Conference. I had the opportunity of interviewing multiple experts within their respective field in the finance and resource sector. So be sure to hit the subscribe button. Take a look at this statistic. Over 91% of people that have watched my channel over its lifetime have not subscribed. So hitting the subscribe button only takes a second, and it is free to you. And for me, when I put out this content, it costs me money and time. So I hope that you all understand that and hope that you consider hitting the subscribe button. So without further ado, let's get to the interview. Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Today, we are here with Scott Melbye of Uranium Royalty and the vice president of UEC, right? Uranium Energy Corp.
Correct.
So got that right. It's up here. And we're going to talk about uranium. This channel focuses on changing financial trajectories and building legacies, and uranium is a way to do that.
Absolutely.
So how do you see uranium, playing a role in generational wealth, wealth transfers and things of that nature? How do you see opportunity there?
I think uranium really fits nicely in a portfolio. If you're creating wealth and you're investing in the resource sector, you're always looking for a commodity that is kind of in balance or heading towards an imbalance that would stimulate higher prices for the commodity and boost the mining equities that underlie that commodity. And nowhere are you going to see better returns than in uranium today. From a supply and demand perspective, we produce about 50 million pounds a year less than we consume globally at 200 million pounds a year. That's a huge deficit, and in any other commodity that would have resulted in higher prices much earlier than we've seen just recently. But our industry has been characterized of oversupply and inventories and secondary supplies. So even though we've been running these big structural deficits year after year, price hasn't increased until recently. And the reason being is the inventories are now gone. So the production discipline that has kicked in, the speculative buying by companies like Sprott Physical Uranium Trust, Yellowcake, has really drawn down the inventories to a point where we're now a production-driven industry again. But we all know that it's not quick or easy to bring on new mines, particularly uranium mines, which have a long permitting licensing lead time. So hence we find ourselves really heading into a very true supply squeeze. And so uranium is now $74 a pound. That's getting to the point which it can incentivize the better mines. But we need higher prices to get the full, I would say, 8 to 10 new mines that need to be built globally between now and 2030 into production.
Yeah, so in terms of like the term market with the contracts and such, what's a price where companies need to come in and contract at a certain price for it to be sustainable for some of the companies? And then also, what does the timeline look like for these terms, and when the old contracts expire and such?
Well, it varies for different companies, but I would say the most competitive mines in the world today, are being incentivized at the $60 to $70 range that we've seen. And that holds true with Cameco has restarted mines in Saskatchewan at McArthur River and Cigar Lake. At UEC, we don't rely on long-term contracts, but we rely on selling into spot contracts at $60 or higher. We've said if we see these sustainable prices for at least 3 months, which would be kind of by December of this year, we'll make a decision to move forward and restart our mines, first in Wyoming and secondly in Texas. So, but I think these are kind of typical of the more competitive mines globally. If you need to spend, $1 billion in capital to build a mine, a mill, underground, conventional mine, you're probably going to need, $85, $90 a pound. And that's taking into account the inflationary impacts on CapEx that all mining companies have faced lately. So we're in an interesting market. The price is headed in the right direction, but I don't expect a flood of material to tamp down that price increase anytime soon. Eventually, yes, markets work. Production will be incentivized, and the market will settle out at a level. But I think we can far overshoot that level into the $100 per pound range probably next year.
Yeah. It's interesting even looking at the price where it's at now, and it's at the levels of 2011, I believe. And so from looking at the charts yesterday, and but this, where we're at now, it isn't even adjusted for inflation.
Yeah, no, that's a good point.
So I'm kind of wondering, this thing could go a lot higher than
what we found in our Texas operations and Wyoming, which are restart of existing operations with existing infrastructure. Even with the infrastructure in place, it's added $10 a pound to our all-in cost, which is now $40 a pound, which is probably first or second quartile globally. But nevertheless, it's $10 a pound more than it was 5 years ago.
Wow. Yes, that's amazing. I was looking at the charts recently. Recently did a video, and we talked about the speculative buying. You had, obviously when SPUT came in, the price shot up fast, really quick. It's almost like the tortoise and the hare, and the price came back down, corrected pretty quick too. There was a lot of retail at that point. Retail investors, and when retail started to sell off and such, you begin to see big volume from institutions buying. So what are you seeing on that end?
The last price cycle we did see prices going up on fundamentals because there were some major supply shocks at mines in Canada and Australia, and then the speculative buyers threw kind of gasoline on the fire that was already lit. What's different this time around is we don't have the inventories that we had back in 2005 to 2007. So, we don't have those buffer inventories to moderate price increases. It's important to note that for much of the price increase year to date in 2023, Sprott hasn't been as active as they've been in the past. They have bought a couple 100,000 pounds in the market over the last week, which is positive. But by and large, the market increase to $73, $74 a pound have been due to other buyers, which is a very bullish statement. It's the utilities, producers, traders, and other hedge funds buying, but it's been a broader market rally, and that's a healthy sign.
Is there any update to just how the supply is looking on a global scale? I mean, obviously we had Russia, Ukraine. There was talk of a bill to ban imports of Russian uranium, enriched uranium, and such. And so, any new developments happening?
Well, you bring up an important point because when we say that there's a 50 million pound gap, structural deficit between production and consumption, that's on a global basis. But I think if you break it down between the East and the West, or if you want to call it the BRICS countries and non-BRIC countries, it's even more pronounced for the West, because I'm pretty sure that the world's largest producer, Kazakhstan, falls in the Russian and Chinese camp rather than Europe, UK, or the United States. So it does have big impact. We get 50% of our uranium in the United States from Kazakhstan, Uzbekistan, and Russia. That could come to an end here quite quickly, either through sanctions, and there's positive developments in the U.S. Congress in that regard, but also just the increased involvement of China and Russia in Kazakhstan. Russia now controls half the production there, and the Chinese are rapidly trying to tie up the other half. So I don't think the West can really rely on Kazakhstan. They need to look to Australia, Canada, the United States, and some African nations that aren't under Chinese control.
Mm-hmm. Yeah, that sounds concerning, and obviously with the terms, us focusing on our energy security, defense, spending and such like that, and oftentimes military, that isn't even brought up a lot of the times when we're talking about the bullish case.
It's an excellent point. My whole career has been focused on producing and selling uranium to utilities for nuclear power generated electricity. But the inventories and the stockpiles that our Defense Department, our naval reactors and aircrafts and submarines, that's largely been met by inventories built up by incentive programs, like we're discussing again today in the Congress, back in the 50s and 60s. But that inventory runs out by, I would say, 2035, 2040. Now that sounds like a long ways off, but in military and mining terms, that might as well be tomorrow. So I'm not surprised that I'm having more meetings and contacts with people in the Pentagon and the Army. There's also not just the naval reactors, but the U.S. military is going all in on small and micro reactors for Air Force bases in places like Guam and Sirleaf in Turkey, or in military forward fighting bases that need to be self-sustained for energy and not rely on diesel convoys, which are very vulnerable in a wartime setting. So the Defense Department gets it. They know they need uranium, and for their purposes, they need to have U.S. origin uranium by global treaties. So while all of our customers to date have been in the energy generation sector, I think going forward, we could see a lot more perhaps business going to the Defense Department, which is great. We'd love to be part of that.
Mm-hmm. That's good. Sorry you all for the jangling keys. I don't know if you all heard that, but it's a lot of keys on this man that's walking by.
That security guy had a lot of keys on his belt.
Yep. So just even, looking out, further, obviously, China's building a certain amount of reactors. Mm-hmm. There's a lot of reactors being built.
Yep. 60 under construction right now globally, and that's before the SMRs.
Yeah, and so like even with that, like how much nuclear fuel or uranium is needed to feed those reactors?
I think we're really underestimating it. Maybe it's a little bit like the electric vehicle market and looking for the need for nickel, cobalt, copper. I think if people are honest with themselves, there's going to have to be a lot of mined materials to support that kind of growth. With uranium, we're in a deficit today, but what happens when uranium demand doubles, which is the expectation by 2040? Not only do we need to kind of build up mines to get back to the previous level we're at, but we need to grow beyond that. So listen, I'm confident that, in the United States anyway, with 1 billion pounds of known and likely resources, Canada being obviously a reliable ally in the U.S., and mines in friendly Western countries, and not just mines, but also the conversion, enrichment, and refining services that go along with it. I think we can be clearly self-reliant again. We were before the Soviet Union broke up. We made room for Russia when they joined the Western markets. We just have to go the other way now and protect ourselves from not just Russia, but China as well. China's going to be bigger than the U.S. in installed capacity by the end of this decade. And they're playing a real serious long game. They're locking up resources in Africa, in Kazakhstan. So I think in the West, we better be strategic in our thinking as well. And I think it's coming. The utilities that I talk to realize this. They see this. They may not be the fastest moving entities out there, but I think they're beginning to take steps to ensure that their uranium supplies are covered off.
Yeah, that's good. That's good. So just transition into uranium royalty and UEC. So uranium royalty is currently the only royalty company to play the uranium market.
Yeah.
And so what's the benefit of that for investors?
Yeah, so we're very excited because, listen, we set out to create the Franco-Nevada Wheaton Precious Sandstorm Royal Gold company in the uranium space. We did that in 2019 when we were still kind of in a bear market for uranium, but we launched the company. We acquired assets, our first 20 royalties on 18 projects. But now with uranium prices increasing, some of those projects are getting back into production or into production for the first time, and we're starting to see cash flow from those. So that's positive, but it also creates a huge market for me to go out and provide financing through royalties and streams and create new assets for the portfolio. That's my number one focus for UROY, is to build the portfolio, and whether it's acquiring existing royalties that already are in existence or new financings, there's a lot of mine development that needs to occur, and I'm traveling to places like Australia and talking to miners in Africa to see how we can provide $10 to $50 million financing to them, and in exchange take a royalty interest in their projects. So we're excited. Our most recent announcement was last week with Uranium Royalty acquiring £1 million of uranium at about $70 per pound. That was very opportune with the market pulling back, just kind of a temporary pullback. We jumped in and bought some uranium.
Yeah, I remember we were texting. I said, "Oh, it's a pullback." I was mad I didn't get in, but it's been times to get in and such. But I mean, every pullback, like the prices just keeps going up higher.
Yeah.
I mean, even same thing with Uranium Energy Corp. Just over, I think it hit $6 a share. I haven't looked at it today.
Briefly hit 6, but pullback. For some unknown reason, uranium equities are down today. But listen, if you're building a position, embrace these pullbacks as a good time to buy, because the fundamentals have never looked better. We're probably in my 40-year career, I've never seen better fundamentals than we have today. So if you do see an opportunity, if a uranium equity that you like has pulled back 2, 3, 4%, jump in and buy, because the long-term trend is up.
Yeah, I'm buying them in my kids' accounts. I'm like, hey, it's gonna pay for your college fund. Like,
that's great.
So I'm definitely accumulating there as well as.
Well, it's great that you say that, because this is a retail conference in New Orleans, and it really, I love making money for big hedge funds and institutions, but at times like this, they go, well, yeah, great, you were supposed to return these kind of gains to us. That's why we bought you. But when you're at a retail conference, people have been coming up the last 2 days and really excited and really grateful that, they had the vision and patience to stay in the uranium investments, and now they're really seeing that payoff in a very big way. And it does matter. I mean, it may matter, make the difference of a kid going to college or a big lifetime dream vacation, or just being able to have a comfortable retirement. We're really happy that uranium investors are being rewarded with that patience and foresight.
Yeah, definitely. Well, appreciate you for coming on, Scott. Where can people find more information about the company and such, and what you're up to?
So uraniumenergy.com. You can follow UEC, which is traded on the New York Stock Exchange. It's interesting, 8 million shares a day traded on the New York Stock Exchange, 2.3 billion market cap. Wow. UROY is traded on the NASDAQ. We're now trading over 1 million, 1.3 million shares a day on the NASDAQ, which is great, but that's uraniumroyalty.com. So if you want a diversified royalty investment in the uranium space, go with UROY. If you want to invest in mines in Texas, Wyoming, and Saskatchewan, UEC is your investment.
All right, thank you for coming on. Appreciate your time.
Thanks, Daryl.